In India, the tax system comprises both direct and indirect taxes, each serving different purposes and affecting various aspects of the economy. Here's a breakdown of both types. Direct taxes are levied directly on individuals or entities and are based on their income or wealth. These taxes are paid directly to the government by the taxpayer. Income tax. Individuals' tax on income earned by individuals, including salaries, business profits, and other sources. Corporate tax on the income or profits of companies and other entities. Key features: progressive tax rates, meaning higher income leads to higher tax rates. Includes exemptions, deductions, and rebates. Wealth tax, which has been discontinued. Description: previously levied on the net wealth of individuals, Hindu undivided families, and companies. Current status: abolished in 2015. Wealth tax was replaced by the additional surcharge on the super rich. Capital gains tax is a tax on the profit earned from the sale of assets or investments such as property, stocks, or bonds. There are two types of capital gains, short-term and long-term, each with different tax rates. Estate duty and gift tax, which are now discontinued, were once part of the taxation system. Estate duty was imposed on the value of the estate of a deceased person, while gift tax was levied on the transfer of assets as gifts. Currently, both taxes have been abolished, and the Gift Tax Act has been replaced by provisions under the Income Tax Act. Indirect taxes are levied on goods and services rather than on income or wealth. They are collected by intermediaries, like businesses, from the end consumer and then paid to the government. Goods and Services Tax, or GST, is a comprehensive, multi-stage tax levied on the supply of goods and services. It subsumed several previous indirect taxes, such as VAT, service tax, and excise duty. There are three main components of GST. First, we have the Central Goods and Services Tax, or CGST, which is collected by the central government. Then, there's the State Goods and Services Tax, or SGST, collected by state governments. Lastly, we have the Integrated Goods and Services Tax, or IGST, applied to interstate supplies of goods and services and imported goods. The rates for GST vary depending on the type of goods or services, with standard rates including 5%, 12%, 18%, and 28%. Customs duty is a tax on the import and export of goods across international borders. There are two main types: import duty, which is levied on goods entering the country, and export duty, which is applied to goods leaving the country. The key features of customs duty aim to regulate trade and protect domestic industries. Excise duty, partially replaced by GST. It's a tax on the manufacture of goods within the country, particularly for items like alcohol and tobacco. Currently, excise duty is now primarily applicable to certain products not covered under GST, such as petroleum products and tobacco. Value Added Tax, VAT, replaced by GST. This was previously imposed on the sale of goods within a state, but since 2017, it has been replaced by GST, which now covers both goods and services. Service tax, replaced by GST. This was a tax on services provided by businesses. Now, it has been integrated into GST as part of the tax on services. Summary: direct taxes are paid directly by individuals or entities based on income or wealth. This includes income tax, capital gains tax, and historically wealth tax. Indirect taxes are collected from consumers by intermediaries and include GST, customs duty, and historically excise duty and VAT. Both types of taxes are crucial for government revenue and have distinct roles in the economic system. Direct taxes are more progressive, targeting income and wealth, while indirect taxes affect the consumption of goods and services.